So let me talk about what I think went on today. For a while now, I've been talking about on the daily chart this becoming a final flag. Before that, I was talking about the stairs, and the stair went sideways instead of down. So I thought it was a good setup for a final flag. Then we had the 3 pushes up, and then double top over here. As of yesterday, I thought the market flipped into a bear market. I believe there's further evidence of that. On the daily time frame, I think we're in a bear market. Weekly, we're clearly pulling back. Monthly chart is trying to form an EMA gap bar. I'm hoping that the month does not become an outside down bar, because that increases the chances of sideways price action. As I said in the daily chart, based upon today, I think that we're going to go down much further. We'll probably get at least a measured move down from these 2 days. So that would take us somewhere down here. I think the market will probably start forming lower lows. So I think we'll take out that. And I'm guessing that we'll come back down to this area during this bear run that we have. I don't know if we'll find support at the start of the channel. I'm guessing that we'll probably rally off here. But I think it looks to me like the odds favor that the high for the next many months is in. It would take months to get us down to this area, and then if we rally up, I could see us stalling halfway up and then trying to come down again. So basically, I think that the market is probably going to be going sideways, down to sideways for many months. Okay. Back on the 5-minute chart, yesterday we had this monstrous selling, a couple 100,000 contracts in 10 minutes because of Obama and his banking regulation. We have a horizontal trading range yesterday. We opened below the range, so and it's only a small gap. If it was a big gap, I would be looking for the possibility of a trend from the first bar bull, and I would be looking to swing. But with a small gap, I'm much more prone to scalp for a test of the close or a test of the moving average. So initially, it looks like we're going to have a failed breakout with the trading range and a breakout. Okay. Second bar, we tested the close, but a bad close on the bar. But there's still decent momentum here. You got 2 bull bodies, so there might be more up. Because of that, I didn't want to short below this. You could argue this is a breakout pullback. You're pulling back to test the breakout of the bear trading range, and therefore it's a decent short. But I thought these 2 bars had enough momentum so that the market would try to test up at least one more time. Here's a second down bar. You got a little micro wedge there. Me, I prefer just 1 test down bar. If I get more than 2, I get nervous. Should you buy the high 2? I don't have any problem with that, other than we're in barbed wire, and that makes it a little bit more risky. Normally, if you're trading in the first hour and you have a bull bar with not much of a tail on the top, you can just trade its breakout. These bars, tails top and bottom, trading their breakout is less certain. Here we get barbed wire and not a heck of a lot of space up above. I personally would wait to see what would happen. Okay, the market might be trying to form an outside down bar, but technically the longs are still alive because the low of their signal bar has not been hit, although they have a bear entry bar. Okay, there's some hope for the longs here, except that the bulls really would have preferred that this close above their entry bar. So at this point, you have a high 2, but it could also be a second attempt to pull back and test the breakout, and therefore, a short below this little double bottom or below that little swing low. Okay, pretty decent bear close below the open. With that, if you're not short on the failed high 2, you got to expect 2 legs down on a failed high 2 on the open. So if you're not short below the double bottom or below this or below the low of the open, you could sell the close. Okay, a second bear bar. If the day is going to be a trading range day, a lot of times you'll have two strong bear bars into a new low, leading to a reversal. If the day is going to be a nasty bear, it could just keep selling off. This bar touched a trend channel line, so there's a possibility that the market could form a second failed breakout. Here's the first failed breakout, might form a second one here. Now, let me just say before I go, the market has had 3 pushes down. 1, 2, 3, or 1, 2, 3, 4. A spike in a channel. So it's clearly overdone on the daily chart as well. Has had a lot of selling. We're into that final flag, which was a tight trading range. Tight trading ranges are magnets. They have lots of two-sided trading taking place. I think the odds favor that we go sideways probably for the next week or two. We were in here for almost 2 months before. It's possible we'll be in here for 2 months now. I doubt it. I think that we're going lower, but we may pause in here because of all this two-sided trading and its magnetic effect. When the market went up, it pulled it back into it. And it's going to tend to keep the market in it for a while. It's possible the market just breaks out and goes right down here. But I think, I'm guessing that Monday we may go up, because of the 3 pushes. Here's a 15-minute chart. The 3 pushes are clearer. So, also with us falling below 1100, I could see that being a little magnet in the market, trying to go back up there again.